And when we have the type of divergence that we have percentage-wise, where utilities dramatically outperform the S&P 500, we usually see a big market correction coming. This happened just before COVID. It happens before a lot of the crashes in the market in general. So that is a warning sign. And of course, gold is on the verge of breaking out. It has been warning us for a long time that the whole economy, the global economy, is starting to struggle, and people are moving away from currencies. They're moving away from a lot of other assets and just going into physical gold. And so gold is kind of the whole global barometer of the whole world's about to probably go through a financial reset of some sort. And gold's the bigger picture of not just the stock market, but kind of the whole economy.
You're watching CapitalCosm. My name is Danny. It is August 8th, 2025, and my guest today is Chris Vermeulen by way of the technicaltraders.com. Chris, thank you so much for coming on the show, my friend.
Thanks for having me, Danny. Always a pleasure.
Always a pleasure myself. Always a pleasure on my end as well, Chris. Let's go ahead and dive into some of the nitty gritty here. What's on your mind? What's on your radar screen? What's front and center for you right now, Chris? You and I were talking a little bit off camera, but from a big picture perspective, what should the average investor have their sensors pointed at right now?
Yeah, we're at a really difficult time to kind of put your finger on which way you should go. So, for example, we have a trend change in the stock market that just happened this week. It is on the verge of it's flipping and flopping. The markets don't know whether they want to go higher or lower. They have run out of steam. But we've got the Magnificent Seven just muscling things higher the last couple of trading sessions. We're seeing 4 or 5 of those Magnificent Seven stocks really push up. And so they're kind of saving the market. But underneath the hood of the markets are pretty weak. So right now we're at this turning point. It's like, do you want to be long? Do you want to be out of the market? And we recently just moved out of the market, and I'll show you some charts here. But overall, from a high level, we're at a turning point, and you got to have a game plan ready. You either need to be ready to be long or get long if you're not, because we could have another leg to the upside, or we could see a big reversal in sell-off. And the charts are pretty interesting. If I pull up the charts, we've got some interesting scenarios here that are kind of unfolding. So let me just show you kind of our trend reversal on the S&P 500. If we look at our trading strategy, which is this color-coded daily chart of SPY, we had a trend reversal early this year, and we went into the tariff crash, and then the market bounced, and we kicked back into a high momentum rally. And the markets right now have turned negative from a technical standpoint. Even though the markets are trading near all-time highs, there's not a lot of strength underneath this market. It's really the Magnificent Seven dragging things up, and things are starting to break down. So right now, sometimes we can get these red bars and it could kick back into a green trend and we have another huge leg to the upside, or it could roll over just like it did in earlier this year and sell off quite dramatically. And so that is where, being an active trader or investor comes into play. Right now is the time to stand on the sidelines. We've locked in profits. And if you take a look at what happened last year, so the top chart is the daily chart of QQQ, the NASDAQ 100. The bottom is of the same chart, but last year, it's 2024. And if you look at this year, the top chart and the bottom chart from last year, I mean, we are like right on the same kind of chart pattern, the technicals, the sentiment, everything is actually very similar to last year. We saw a 15% correction. It came back down to near the April lows. The market's a lot higher from the April lows. We'd be more like a 25% correction if this was to kick in and repeat. Not saying it's going to happen, but this is something people need to be aware of. And this scenario, this trend change is exactly what took place last year. So that's kind of where we are in a nutshell. Is like, which way are we going to go? We just stepped out of the markets, and the markets are trying to figure out, are they going to continue to go higher and give us confirmation, or are they going to, is this just a little bounce, a little kind of dead cat, or more or less a sucker's rally, gets people in just before it breaks down and really goes precipitous off a cliff. So that's what I see in the markets there, Danny.
Yeah. And you mentioned it could go either way. I mean, these markets have been fairly versatile in that regard, but you can clearly see the deceleration happening on the, what is that? The S&P you've got there as well. You can see we've been kind of arching, and we've kind of hit a pinnacle there.
Yeah, we've seen bearish price action where the days keep opening higher and selling off each day, and gaps to the upside and sell-offs. Volume is starting to ramp up. We had very similar price action over here earlier this year. It sold off a bunch of days back to back, kept
Mhm.
opening higher and then getting sold off. We saw volume starting to ramp up, and this is what we saw last year at the same time, more or less July, August, when this same pattern unfolded. So the momentum is totally stalled out. It's just the Magnificent Seven. If we look at the Mag 7 ETF, which gives us the basket of all of them,
Mhm.
they are pushing up and set to close at new all-time highs. And these are doing a lot of the heavy lifting. And we're seeing, Meta, Tesla, Apple, and all of those, and Nvidia pushing higher. And so it's kind of camouflaging. Yes, the market is moving higher, but it's very weak, and it's a bearish sign overall. And there's a couple other things that actually flash that as well, like utilities, for example. If we look at XLU, utilities have dramatically outperformed the S&P 500 in the
Mm.
same window. The S&P 500 has moved up or more or less sideways this whole time. And when we have the type of divergence that we have percentage wise, where utilities dramatically outperform the S&P 500, we usually see a big market correction coming. This happened just before COVID. It happens before a lot of the crashes in the market in general. So that is a warning sign. And of course, gold is on the verge of breaking out. It has been warning us for a long time that the whole economy, the global economy, is starting to struggle, and people are moving away from currencies. They're moving away from a lot of other assets and just going into physical gold. And so gold is kind of the whole global barometer of the whole world's about to probably go through a financial reset of some sort.
Mm.
And gold's the bigger picture of not just the stock market, but kind of the whole economy.
And might I remind, not just you, but just in general, that the last big sell-off we had, i.e., the Liberation Day sell-off back in the spring of this year, we did see sell-off in the stock market indices, but from a gold pricing perspective, gold held up relatively well.
Yeah.
So was that
Yeah.
like
I mean,
is that something to expect if we see another one of these big sell-offs down the road?
yeah, I really like gold. I mean, it has a lot of really strong characteristics. It's had a series of rallies and pauses. As you know, these are known as bull flags, and
Mhm.
it's trying to break out right here. I want to get long gold for a trade. I think there's upside potential to about 4,100, about a 19% rally. Back in 2007, when we saw a very similar stock market scenario unfold, I think you and I touched on this last year, or sorry, our last talk. But the left chart here is the S&P 500 in 2007. The market's made a high, and then it came up and they made a nominal, just a small higher high. And during that time, gold was ripping higher and it was outperforming the stock market. Well, fast forward to today, we had a high in the stock market. Now we've got a nominal new high. Gold is the number one performer yet again. It's been moving higher. And this is a big warning sign. And what happened, if we look at 2007, as I move forward, the stock market started to fall, and watch the yellow line, which is gold. It really starts to break out and take off and extend to the upside. And gold rallied. Back then, the projected target was about 20%, very similar to what we have right now on the gold chart. But gold ended up rallying 37%. It blew right past it. It became the crowded trade, and it just shot past there. So I think we're getting very close to that same scenario. And of course, if that was to play out, if you look at the stock market price, eventually the stock market breaks down and we went into the financial
Mhm.
crisis. Stocks fell 55%. Gold pulled back eventually with the bear market. But that's where I think we could be heading with the equities market at some point. But we just need those Magnificent Seven to stop getting the money flows into them, which keep dragging these indices higher and higher. But I like the opportunity in gold. As you were saying, it's the charts look really good, and I own a lot of physical gold for long term, and I only buy new physical gold during the start of a new major super cycle. So this trade that I'm looking in gold, it'll probably just be like an ETF, like a GLD or the Sprott Gold ETF, the physical fund. But when you look at the chart of like GLD, for example, Danny, it hasn't broken out yet. If I look up
Mm.
GLD, we're not
And,
breaking out. And
and
sorry, go ahead.
No, I was gonna say, and neither has spot gold either. I mean, you're looking at the futures price, but if you look at the spot price as well, I mean, it's still relatively subdued. But go ahead and finish your thought too.
Yeah, so we haven't seen gold break out on GLD, and what I like about GLD, and a lot of my charts actually are usually regular trading hours only. So I only show price action um, during 9:30 to 4 o'clock. That's when the majority of volume shows up for looking at ETFs. And so when gold like GLD actually closes and breaks to a new high, I'll actually be pretty excited because I feel like the breakout will have started. And it hasn't started there yet. I know people are jumping the gun. And when you look at the futures chart, as you just mentioned, the futures chart has broken to new all-time highs today, but really it hasn't in the grand scheme of things when you look at the ETFs and spot price. And what's interesting here is when we look at the gold miners like GDX, even the silver miners, they have already popped and they've already broken out.
Mm.
And if we use a Fibonacci target here to get an idea on this high momentum, this high volume rally, and this pullback, and we carry that forward, we have seen gold gold miners do what we want. They have come up to the 618 level. They've traded sideways for a very long time. If something trades sideways at the golden ratio of 618, we almost always see it go up and hit the 100% measured move, which GDX has now done. And what I like about gold miners when we're in a favorable precious metals market like we are right now is miners move first in most cases, and then gold pops and breaks out. So miners have just hit their target. I'm expecting they're actually could see a bit of a pause or pullback. Gold now, I think, is locked and loaded and ready for its first pause, just like the miners have. So I like gold because it's really ready for this first move. And I think we can get positioned into it any day here once we start to see it actually break out. So that's kind of my short-term take on gold and the long-term, that eventually gold will pull back to some regard if and when we hit a financial reset, a bear market. But that's going to be many, many months down the road still.
So $4,100 gold. A couple of questions.
Yeah.
How did you arrive at that forecast? And then number two, what's the time duration for that?
Yeah. So based on this bull flag chart pattern, we just take the low. You can use bull flags or Fibonacci, but we take the momentum of this rally up, the height of this rally, and then how deep this three-wave correction was, and we'll just carry that forward. So when we look at price action, we're going, okay, so it had this much power to the upside, it had this much correction power. Where is the upside projected target? And 618. So 61% of this first move is the first target. That's known as the golden ratio. If you ever look into Fibonacci theory, the sequence, it is in everything in the universe, and it's pretty powerful. So these targets that I'm looking for is going to be about 3,700 is the first target. We'll probably see some pause and hiccup there for a few days or potentially a couple of weeks. And then we should have to head up to around 4,100. And just based on kind of this chart pattern, I think the move we're in now is actually going to be quicker and more explosive than this last one. This last one took more or less 1, 2, 3, 4, 5 months. I think this one could happen in like 2 or 3 months, maybe even less. It really depends. We're in this like explosive phase where it should happen very quickly. It'll be a crowded play. I think there's going to be a lot of emotions, a lot of money pushing around, which will create I think a very quick move. So it's a short-term trade, a month or two, and that's my outlook there.
Why do you think GLD and the spot price haven't broken out yet versus, let's say, the mining stocks have? I mean, which one do you anticipate being correct here? What's stopping the ETF, the GLD ETF, from breaking out?
Well, I think it's also only clocking price action in regular trading hours. So gold spikes up high, like today, it spiked up to a new all-time high and a high price. But by the time the 9:30 a.m. opening bell starts, gold is already sold off. There's always a chart I used to look at on the Kitco. It shows you 3 days of gold overlaid on top of each other. I'm actually going to be doing a video on how to day trade gold with it because it's really powerful. But you can see these huge spikes and sell-offs that happen almost at the same hour, the same time every day. Is when the gold market opening closes in London and different places around the world. And GLD just captures a snapshot of what gold has done during the regular trading hours. It's only about a third of the day's trading hours. Gold's 24 hours a day. The stock market, the ETF is only about 8 hours. So that's why we're not seeing these spike highs and lows in GLD, is simply because it's just capturing the snapshot kind of a third of the day. But that's where most of the volume is traded. That's why I like following regular trading hours. Manipulation happens outside of regular trading hours a lot more. Once the market opens, it's a lot harder to manipulate things because there's just a ton more volume you have to try to fake out and shake out. So focusing on regular trading hours for a breakout I think it's pretty important.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. Can't you say the same thing about the mining stocks, though? I mean, they have their own trading hours as well.
Yep. Yeah, I mean, but this is it. Mining stocks, they've already broken out. They've had that pop in the breakout. That's a good thing. That's a leading indicator. Now we can focus on gold and be with our finger on the trigger. I find gold miners are in this type of scenario, which we saw like in late 2008 or early 2009. Gold miners are the leading move. They'll run and take off, and then physical gold will move next. So I look at gold miners a lot of times as like more or less the kind of shot across the bow, like kind of the get ready. Miners are already moving. I think the reason miners move is because smart money understands that we're in a sweet spot for gold to move higher. They realize there's global chaos, and so they move into the leverage play. If gold is slow, right? A big day in gold is usually like 1%. Miners can move 5 to 8%. The ETFs and individual stocks can move like 20, 30%. So savvy money who's very aggressive, they're going to go into the miners before gold moves because they want to be in position. And so just a bunch of people do that, and it causes the miners to move first for their first leg. And then we'll probably see gold break out, and then miners will take off probably with another leg higher. It's just smart money or aggressive money moving in, front running what they think is going to happen with the price of gold.
I see. Let's talk about silver as well. What's your take on silver? How does silver's interaction play out here?
Yeah, silver has a much more noisy chart. I've never been a huge fan of silver until we're in like a different type of market correction. We won't go there, but long story short, silver is still pointing to higher pricing. It's just always really noisy. It is easy to get shaken out of a silver trade. You really have to like take a position and kind of sit back and play the overall longer trend, which when you look at this chart, obviously we have a series of higher lows, a series of higher highs. It's working its way upwards. But you got to go through a lot of 20+% corrections, 10, 15, 20 to stomach it. But if gold breaks out, we're probably going to see silver shoot up. I think the next target for us for silver is about $40.80. It's a pretty ugly chart, hard to gauge based on this sell-off of where it wants to go, but about 40.80. I think there's actually more potential at this point in physical gold itself, just based off what the chart patterns are giving us for targets. Gold is about 18%. Silver is, based on where it is right now today, it's really only looking at, 5-6% potential to the upside. Now it could blow past that, but the chart is only saying 6% and gold's showing 18, and gold has a much higher probability of actually working out. The patterns in gold play out way more often than in silver, meaning it's more accurate. You've got less risk, a higher probability. So likely for gold to trade will work out, and you make 3 times as much money as silver. So that's why I'm like kind of steering clear of silver, and the miners also. I like the more consistent play, the one that's likely to work. I like to win versus swinging for the fences and striking out, or just going through that roller coaster ride if you don't have to.
Right. So looking at SIL, which is the silver miners ETF, that too looks to have broken out as well.
Yeah.
Can't we make the same conclusion though, that the smart money is putting their capital into the silver miners and further out the risk curve? And isn't that an indication that we can anticipate higher silver prices as well?
100%. Yeah, it is. The miners, the money's moving into the miners. They want to catch a big move, right? So silver and gold miners are moving up. I'm not saying silver is not going to move up. I'm just saying the charts are saying gold is going to move up more. It's more of a global play, where silver to me is more of a speculative play. It's shorter term. It moves very quickly. There's nothing wrong with silver. I just think gold has the highest probability of playing out and can make more. But we should see miners and gold and silver move up together to some regard.
Understood. Let's go ahead and talk about the other the other white metal, and that is platinum. Platinum made some big moves last month. It's corrected since, which is pretty predictable given the sudden rise that it saw last month. But what's your take on platinum?
Yeah, if we take a look at platinum, I mean, it had this huge running correction to the upside. It's been in this huge stage 1 base for years, really trading sideways. It's exploded to the upside. I'm not sure if you and I touched on this last time we chatted, but this running correction is very dangerous. I've talked about it several times on my in my analysis on my YouTube channel, saying, if you're in this, make sure you tighten up your stop, because these end very, very dangerously. They can blow off to the upside and then crash, or they just fall out of bed and they crash and unwind. This overall type of running correction, meaning instead of the market running up and creating a bull flag and taking a pause and then having the second half, what this is doing is it's running up in price, and then it's just shaking the heck out of investors. It's big rallies and big sell-offs, and it's scaring people. It's correcting, shaking them out on the way up. It's very unstable. It's very similar to, I live on the water here. There's an island, and it has a flagpole. And on a nice breeze, the flag is flagging down, just like this over here. You have a flagpole, and then the flag has weight to it, so it flags downward. But when a storm front hits, more or less the flag is streaming up and it's flapping. And that's what these are. This is like huge momentum. It is, it could continue to go higher, but just know at any point it's going to fall out of bed and have a big correction. So I'm not a fan of it. It has a bearish pattern. It is pointing to lower pricing. This is a bear flag now, pointing to probably around 1120, 1160, somewhere in there to the downside. So I'm not a fan of it at this point.
And is there anything we can tell from the price of copper as it relates to the greater economy, given the fact that it's often coined the term Dr. Copper?
Yeah. So copper, I don't follow it too much. I used to look at it, but when you look at the big picture of copper, I mean, we've got these, a bunch of significant highs through here. So if I was to just draw a line through all of these highs, whenever we see copper get up to these levels, we tend to see a very big correction in price. And we got to that level and we blew through that. And it was a news-driven move. We had a bunch of stuff about tariffs and potentially some other things. I don't follow the news too much, but this was a huge news-driven move, and it blew through a level that naturally gets sold into many times over many years. So when there's a news-driven move, you got to be very cautious. You cannot trust it. You should not trust it, because whatever happens on news, once that momentum and that news works through all the sources and all the investors think it's the next shiny thing to buy, once that buying dissipates and runs out of steam, it just falls out of bed. And maybe there was more news that created this huge 20+% drop to the downside. So I don't like to mess with things when they're at major resistance and have a news event driven to it. Overall, I think the economy is slowly weakening under the hood. And I think we're eventually going to probably see copper break down and have a big move. But I would just steer clear of copper. It's got a lot of noise, it's got big price gaps, it's got all kinds of big news around it. So I'd be just cautious if you're playing with that.
Gotcha. And what about, let's go ahead and segue over to the debt markets. The debt markets have been kind of moving sideways. The TNX, a 10-year yield, looks like it's basing out somewhere around 4.1 to 4.5, something like that over the course of the last 2 years or so.
Yeah.
What's your take on what we're seeing in the debt markets?
Yeah, I mean, interest rates are they're sticky. They're holding up. I mean, if we zoom way back in time, so many investors are used to falling interest rates and bonds. As rates go down, yields go down, bonds go up. A really good example, of kind of what's unfolding is if we take a look at this. Let's see if I can just zoom out a bit. There's obviously 4 stages to the market, which you and I have talked about a few times, Danny. And these 4 stages, yields eventually put in a massive top, a stage 3 top, just like over here. And then they've gone through a huge bear market. Now rates have gone through a bottom, which is a stage 1 basing formation. And now they're building a launch pad and they're starting a stage 2, pointing to higher pricing. This chart pattern is actually, it's pointing to a really high yield. It's pointing to like 8% if you were to use technical analysis based on this chart. Obviously, that'll wreak havoc. It means there's going to be a financial crisis for sure if not that happens on all kinds of levels. But that's what it's saying, and so it's pretty scary of what the debt market is saying about this.
And are we seeing the 10-year yield break out of its correlation to the short end of the yield curve as well? As you recall, in the fall of last year, they cut rates 100 basis points, and you can kind of see it in the 10-year. Like, it actually went up from the start of the cut all the way up until the last cut. Yeah. And then they had to stop. They just stop short.
Yeah, I don't follow that too much. I really just kind of look at the overall yields and just the overall price action. So I'm not sure how those play into each other too much.
What happens when, aside from a financial crisis, but an 8% interest rate on the 10-year, what does that imply for like everyday people?
I don't know. I would think mortgage rates will be through the roof. Home prices will crash, which is what I'm expecting anyway. It's gonna wreak havoc on the stock market. It means things are falling apart. If you can collect 8% return with really no risk, people are going to move out of the stock market because a lot of people are worried the market's overvalued. They think it's going to fall. Valuations are out of whack. So it's naturally going to be like, hey, I'll take 8% every day here with no downside risk. So the stock market will be crashing and crash. It'll be terrible. It'll be a financial reset. And that's probably why gold has been doing so well. It's why gold is primed and ready. Just like this chart here, it's a giant bull flag. They're both ready to move higher. And so, yeah, I think it'll be very difficult for everyday people. The stock market will probably become very weak. And the big problem is a lot of people with homes, their home prices are going to drop dramatically. I see like another 15 to potentially 30% drop in the housing pricing if these bubbles and this type of stuff unwinds. And that's a conservative outlook. I remember in 2008, we were looking at homes in Florida, and the house that we were looking at was 550 grand. And my parents ended up buying one there, the same one, for 175 grand. I mean, we're talking like potentially big resets, and every state and city will have different levels, but volatility. But yeah, this will be very difficult for people and businesses and all of that if it happens.
I see. Well, I think we've covered a whole host of different topics here, Chris. I can't think of anything else to talk about. Anything that you want to talk about before we wrap up here?
I think we covered it. I think that's really about it. I think in a nutshell, people just need to know the markets right now are like at a tipping point, and the markets could roll over. We could have a magnificent 7 run higher and drag these markets up. So you kind of have to be nimble here at this point and just bend to the will of the market. If it says get back in, we'll get long. If it rolls over, well, we're going to be protecting our capital. And there's a couple other, discretionary plays that I like. I like the gold play. I like betting against the energy sector. I think the energy space is about to fall. And I like Bitcoin, but only if the stock market gives a new buy signal, because Bitcoin moves similar to the NASDAQ. So there's some interesting plays just around the corner, and the market just has to pick a direction here probably in the next session or 2 or 3. I think next week will be a turning point for new positions to be put on. And and get ready for the next run.
What are some signals that you look for to identify a turning point in either direction?
I mean, when we're looking at the overall stock market, there's a whole bunch of things. I use about 12 different assets and ratios to identify money flows and velocity and cycles. I use technical analysis, just simple price trends. Is it trending up or down? Price patterns, money flow. There's a lot that actually goes into identifying it, which is why when you looked at that signal chart I had of the S&P 500 that was red and green bars, even though we're right near all-time highs, we actually have a sell signal. So there's a lot more to it than just price. They're saying like, yes, price is going higher, but it's not a strong move. It's kind of a fake drift higher, which it is. It's Magnificent Seven drifting things up. And so, yeah, there's a lot that goes into it. And yeah, it's kind of, we have our own kind of secret recipe of identifying it to keep us ahead of the curve and to avoid market corrections and stuff like that. But it's not as simple as a moving average crossover or breaking to new all-time highs. There's a lot more to it.
Understood. Chris, where can people find you if they want to see more of your work?
The best would be to go to YouTube, go to my YouTube channel, thetechnicaltraders.com. You'll see daily videos. Keep you updated on what's going on, share all kinds of insight and short-term trades if you follow the charts, and then go to my website, thetechnicaltraders.com, and follow me there with a free newsletter. And pretty much I share my trades. What I do with my portfolio is what I share in my newsletter. If somebody wants to copy the exact ETF trades I do, you can just subscribe and follow me there.
Excellent. We will have the link to all that stuff down below. So check it out, guys. If you got value out of this podcast, drop us a like and comment. Go Crisco in the comment section. If you disagreed with anything or agreed with anything, let me know either way. I do, in fact, read the comments, good or bad. So very interested in getting your thoughts, and subscribe to the channel so you don't miss an episode, and liking, subscribing, commenting, doing all the YouTube stuff that you always, that YouTubers always tell you to do. That does go a long way in helping push this channel and this video in the algorithm. So it's a big help, no matter how little it may seem. And with all that said, thank you guys for watching, and be sure to check us out on Substack as well at capitalcosm.substack.com. All right, guys, I'll talk to you later.